Hello, this is your daily dose of financial market trends. The United States just made a major move to break China's stranglehold on rare earth minerals, and the fallout could reshape semiconductor and electric vehicle stocks for years to come. Heading into today's session, Friday's close had the S&P 500 at 7,757, up 0.6%. The Nasdaq finished Friday at 26,690, gaining 1.3%, while the Dow closed at 54,036, up just under 0.3. The VIX ticked up nearly 4% to 15.45, while the 10-year Treasury yield pulled back to 4.66%. SPI is catching massive attention this morning ahead of what could be a pivotal Federal Reserve decision next month. With mixed jobs data taking some urgency out of the tightening cycle, markets are watching inflation prints closely to see whether the Fed pauses or pushes forward with another hike. This balancing act is keeping broad market sentiment cautious but hopeful, and index positioning is reflecting that uncertainty. JP Morgan is generating serious buzz as European economic recovery starts looking more credible. The continent's growth rebound is shifting sentiment around multinational banks with deep European exposure, and JP Morgan stands to benefit from improved lending conditions and capital markets activity across the Atlantic. Investors are reassessing whether the worst of the transatlantic headwinds might finally be behind us. Nvidia is front and center as the rare earth supply chain story unfolds. The U.S. backing Australian mining operations to sidestep Chinese supply dominance has direct implications for chip manufacturers who rely on these critical materials. Nvidia gained over 2% Friday, and traders are weighing whether secure access to rare earths will stabilize costs and timelines, or whether Chinese retaliation creates bottlenecks that could disrupt production schedules and squeeze margins. AMD is on the opposite side of that same equation. Down over 1% Friday, the stock is feeling pressure from the same rare earth concerns. If China responds aggressively by restricting exports or processing capacity, chip makers could face input cost spikes and extended fabrication delays. AMD's positioning in both consumer and data center chips makes it particularly vulnerable to supply chain disruptions that raise costs without an easy path to pass them through. Tesla is also in the mix, up nearly 3% Friday as the rare earth conversation extends to battery production. Electric vehicle manufacturing depends heavily on these minerals, and Tesla's vertical integration strategy could either insulate it from or expose it to whatever comes next in this geopolitical chess match. Let's dig into the macro scenarios shaping risk right now. First up, U.S.-China rare earth supply chain decoupling. America is financially backing Australian rare earth mining to cut reliance on Chinese minerals, essential for defense and tech manufacturing. The bull case, sitting at 35% probability, envisions the Australian project scaling quickly and establishing reliable supply within 2 years. That would give Western manufacturers supply security and pricing leverage, making capital expenditure more predictable and supporting margin expansion in chips and EV production. The bear case, at 45%, is more concerning. If China retaliates by restricting rare earth exports or processing, we'd see immediate supply shortages and input cost inflation of 20 to 40%. That would extend semiconductor timelines, spike battery costs, and compress margins across tech and defense, triggering broad sector valuation contraction. Next, the Iran oil supply disruption and blockade. Iranian crude exports have stalled under U.S. naval blockade, pulling significant supply offline, while Chinese inflation eases. The bull case, at 25%, sees diplomatic progress leading to partial sanctions relief, and Kharg Island resuming 50 to 70% of exports within 60 days. That would drop crude 15 to 25%, easing inflation and letting central banks stay dovish, with immediate margin relief for transportation and manufacturing. The bear case, at 40%, assumes the blockade drags past Q3 and Iran threatens the Strait of Hormuz. Crude would surge above $110 per barrel, forcing central banks to stay restrictive despite growth concerns, reigniting goods inflation, and raising recession risk as energy costs hammer consumers. Finally, the Federal Reserve's September rate decision. Mixed July payroll data has reduced tightening urgency, and markets are waiting on inflation data to gauge September's move. The bull case at 55% sees August inflation below 3.2% and continued labor softening, leading the Fed to pause. Duration assets would rally, 10-year yields could fall 30 to 50 basis points, and equity multiples would expand as rate cut expectations for next year climb above 70%. The bear case at 30% has core inflation sticky above 4% and wage growth reaccelerating, prompting a 25 basis point hike. That would push the 10-year toward 5%, compress growth stock multiples, tighten financial conditions, and raise 2024 recession probability pricing to 50% or higher. On the housing front, 30-year mortgage rates sit at 6.69%, while inventory has climbed to 9.3 months of supply, well above a balanced market. That surplus is giving buyers negotiating power and putting pressure on builder margins, especially if rates stay elevated and demand continues to soften. No major earnings from our tracked watch list this week, so the focus stays on macro drivers and geopolitical developments rather than company-specific catalysts. Here are 5 things worth watching. 1. Rare earth supply chain developments could create real winners and losers in semiconductors and EVs, so keep an eye on how China responds to the Australian mining push, and whether Western manufacturers secure alternative sources before costs spike. 2. The Fed's September decision hinges entirely on August inflation data, making the next CPI print more consequential than usual for both bond and equity positioning. 3. Elevated housing inventory, combined with mortgage rates near 7%, is setting up potential margin pressure for homebuilders if demand doesn't stabilize soon. 4. Iranian oil supply disruption is keeping a geopolitical risk premium in energy markets, and any escalation or resolution will move crude prices sharply in either direction. 5. European economic recovery is shifting sentiment for multinational financials with transatlantic exposure, creating a narrative worth monitoring as growth data continues to improve. As always, this is educational content, not financial advice, so do your own research and match any moves to your personal risk tolerance and time horizon. That's your Morning Market Digest for Monday, August 10th. We'll be back tomorrow morning with the latest market moves. Trade safe out there.